The Downside Tasuki Gap is a continuation pattern observed in a downtrend. It is identified by a specific formation on the candlestick chart, suggesting the continuation of the ongoing bearish trend. The pattern consists of 3 key candles. The first 2 are black or red candles, which show a continuation of the downtrend with a gap between them. The third candle is white or green, starting inside the body of the second candle and closing within the gap but not covering it entirely. This particular formation indicates that while there is a temporary pause in selling pressure, the overall bearish sentiment remains strong, and the downtrend is likely to continue. In concluding the discussion on the Downside Tasuki Gap, it's important to chart the path with this pattern carefully. Despite its indication of a continuing downtrend, investors and traders should look for additional confirmation before making decisions. This could come in the form of subsequent candlestick patterns, volume analysis, or other technical indicators. The presence of a Downside Tasuki Gap offers a strategic point for considering short positions or for exiting long positions to minimize potential losses. However, like all trading strategies, it's crucial to incorporate stop losses and to consider the broader market context to mitigate risks effectively. By understanding and applying the Downside Tasuki Gap within a comprehensive trading plan, investors can navigate the downtrend with greater confidence and precision. The section titled Introduction, unveiling the mystique of rare and exotic patterns, sets the stage for an exploration into less common, yet fascinating patterns observed in various fields like nature, art, and science. These patterns, by virtue of their rarity and unique aesthetics, captivate observers and demand a deeper understanding of their origins and implications. Rare and exotic patterns stand out because they are not frequently observed, making them subjects of curiosity and study. For instance, in nature, one might encounter the striking and intricate patterns of a rare butterfly's wings or the mesmerizing arrangement of colors in a seldom seen flower. In art, an artist may employ unusual techniques or materials to create patterns that challenge conventional perceptions of beauty and form. Understanding these patterns involves looking beyond their immediate visual appeal to appreciate the complex processes that give rise to them. This might include the specific environmental conditions needed for a rare plant to bloom, or the innovative artistic methods that lead to the creation of novel patterns. This introduction aims to entice the audience into a journey of discovery, where they will learn about the unique blend of elements that contribute to the formation of these rare and exotic patterns. It emphasizes the beauty and intrigue that these patterns hold, inviting readers to appreciate the intricacies and stories behind them. Identifying rare and exotic patterns in the financial markets involves looking for unique formations in price movements or trading volumes that do not occur frequently but can signal significant future price movements. These patterns, unlike the more common ones like head and shoulders or double tops and bottoms, require a keen eye and often a deeper understanding of market psychology and dynamics. For example, a rare pattern might be the diamond formation, which signals a potential reversal of the prevailing trend. Its distinct shape, created by a broadening followed by a narrowing of price movements, requires careful analysis to be recognized and acted upon. Another example could be the Elliott wave pattern, which posits that markets move in predictable, repetitive cycles, but recognizing its start and end points can be complex and subjective. To identify these patterns, a person would typically rely on a combination of chart analysis, historical data review, and an understanding of market sentiment. Tools like candlestick charts, which visualize the high, low, opening, and closing prices for given time frames, become invaluable here. Along with these tools, the ability to intuitively understand the possible implications of geopolitical or economic events on market psychology can also play a critical role in recognizing rare and exotic patterns. In essence, while the technical aspect of identifying these patterns involves analyzing charts and data, there is also an art to interpreting the subtle cues and nuances that distinguish rare patterns from the normal ebb and flow of the markets. It is this blend of art and science that makes the identification of rare and exotic patterns both challenging and potentially rewarding. Deciphering market sentiment involves understanding the collective feelings or attitudes of investors towards a particular market or security. This process is essential as it helps in predicting future market movements and making informed investment decisions. In focusing on rare and exotic patterns, analysts look for unique or less common indicators within the market data that can provide insights into potential trends. These patterns, due to their rarity, may not be well known but can signal significant shifts in market sentiment. The identification of these patterns requires a blend of technical analysis, historical data comparison, and market intuition. Analysts use charts to visualize these patterns and apply statistical tools to validate their findings. For instance, an unusual pattern in trading volumes or a sudden shift in the price movements of a security can hint at changing market sentiment before it becomes evident through traditional indicators. By understanding these nuances, investors can gauge the market's direction more accurately and potentially capitalize on trends before they become mainstream. It is akin to reading a subtle change in the winds before a storm. However, it is crucial to approach these patterns with caution, as their rarity also means there are fewer historical precedents to gauge their reliability. Hence, thorough analysis and a balanced approach are key to leveraging rare and exotic patterns in deciphering market sentiment. Rare and exotic patterns in the context explained are unique signals that emerge from the financial markets. These patterns might not be as widely recognized or frequently encountered as more traditional indicators, yet they hold significant value for the discerning analyst. The nature of such a pattern lies in its ability to provide insights from the periphery of usual data analysis. It sweeps through the noise of everyday market fluctuations to pinpoint potential turning points or opportunities not immediately apparent through conventional methods. Engaging with these signals requires a nuanced understanding of market dynamics and a willingness to explore beyond standard analytical approaches. Such patterns can illuminate paths to strategic decisions that harness untapped market potential, offering a unique advantage to those capable of interpreting their subtle cues. Confirming the signal within the context of rare and exotic patterns in technical analysis involves several steps to ensure the accuracy and reliability of the pattern recognition. Initially, it's important to identify the pattern correctly, considering its unique characteristics and attributes. This involves looking at the shape, size, and position of the pattern within the broader market trends. Once a pattern is identified, confirming its signal necessitates observing specific indicators and evidence that the pattern is about to result in the expected market movement. This could include looking for an increase in trading volume as a confirmation that the market is aligning with the pattern's prediction. Additionally, Other technical indicators such as moving averages, relative strength index (RSI), or moving average convergence divergence, MACD can provide further evidence supporting the pattern's validity. It's vital to approach this analysis with patience, as rare and exotic patterns may take longer to form, and their signals might not be as immediate as more common patterns. Waiting for a clear confirmation through additional indicators helps in reducing the risk of false signals. In essence, confirming the signal of a rare or exotic pattern involves a thorough analysis combining pattern identification with corroborative evidence from trading volume and other technical indicators. This methodical approach assists in making more informed decisions based on the pattern's implications for future market movements. When exploring the subject of rare and exotic patterns within the context of technical analysis, it is important to discuss the reliability of the signals these patterns generate. Rare and exotic patterns are unique formations on price charts that occur less frequently than more common patterns, but can indicate significant market movements when they do appear. The reliability of the signals generated by these patterns is contingent upon several factors. Firstly, the context in which a rare pattern appears plays a crucial role in its reliability. These patterns do not operate in isolation. Market conditions, volume, and the presence of other confirming indicators can enhance or diminish the strength of the signal. For example, a rare pattern that appears in a strong uptrend might have a higher likelihood of success than the same pattern in a less decisive market. Secondly, the trader's experience and interpretation are pivotal. Identifying these patterns requires a keen eye and experience, as their rarity means there are fewer examples to learn from. A seasoned analyst may discern subtle clues that increase confidence in the pattern's predictive power, while a less experienced observer might miss these nuances. Lastly, it's worth noting that no pattern, rare or common, offers guarantees. The financial markets are influenced by an array of unpredictable factors, and risk management should always be a trader's priority. Incorporating rare and exotic patterns into a broader analysis, considering both technical and fundamental viewpoints, can provide a more rounded and robust investment strategy. In conclusion, while rare and exotic patterns can provide intriguing insights and potential opportunities for traders, the reliability of the signals they produce is dependent on context, the trader's experience, and the application of sound risk management principles. When integrating rare and exotic patterns within the framework of technical analysis, it becomes clear how these unique formations can enhance a trader's insight into market dynamics. Rare patterns, due to their infrequency, might not be well known among the general trading public, but they offer valuable predictive capabilities for those who can identify them. These formations, ranging from specific candlestick arrangements to complex chart patterns, serve as key indicators of potential market shifts, offering a predictive edge. The synergy between these rare patterns and established technical analysis tools creates a comprehensive view of the market. For example, combining the predictive power of an exotic pattern with the widely used tools like moving averages and relative strength index can confirm the strength and potential direction of a market move. This blend allows traders to validate their predictions made based on rare patterns, thereby strengthening their trading strategy. Tools such as volume analysis and trend lines, when used in conjunction with rare patterns, provide a multi-dimensional view of market sentiment. Volume analysis can confirm the strength behind a formation, suggesting whether a pattern signals a genuine market reversal or continuation. Trend lines, on the other hand, help in determining the sustainability of the market's move post-pattern formation. In essence, while rare and exotic patterns stand as potent signals on their own, their real power is unleashed when combined with other technical analysis tools. This integration not only validates the signals provided by rare patterns, but also enhances the overall analytical framework, leading to more refined and confident trading decisions. Navigating the pitfalls of trading rare and exotic patterns requires a strategic approach. First, it is essential to recognize that these patterns, while potentially lucrative, carry a higher degree of risk due to their infrequency and the complexity of their interpretation. To mitigate these risks, traders should prioritize thorough research and backtesting. This involves studying past occurrences of these patterns, understanding the conditions under which they emerge, and testing how strategies based on these patterns would have performed in the past. Second, maintain a disciplined risk management strategy. This means setting clear stop-loss orders to limit potential losses and deciding on profit targets to secure gains before market conditions change. The volatile nature of markets where rare patterns occur makes this step crucial. Third, diversification should not be overlooked. Even if a trader becomes proficient in identifying and leveraging rare and exotic patterns, they should not rely solely on these for their trading strategy. Incorporating a variety of methods and not putting too much capital into one speculative strategy can help spread risk. Lastly, continuous learning is vital. The financial markets are dynamic, with patterns and effective strategies evolving over time. Engaging with a community of traders, staying updated with market news, and regularly reviewing and adjusting trading strategies based on outcomes are all practices that can enhance a trader's ability to navigate these complexities successfully. In summary, while trading based on rare and exotic patterns can offer significant opportunities, it demands a well-thought-out approach that includes rigorous analysis, strict risk management, diversification, and a commitment to ongoing education. In exploring the realm of rare and exotic patterns, particularly focusing on its strategic applications, it is crucial to understand how these unique patterns can enhance decision-making in various contexts. Rare and exotic patterns are often observed in fields such as market analysis, environmental studies, and even in the social sciences. Their strategic application lies in the ability to spot unusual occurrences that could signify critical turning points or opportunities. For instance, in market analysis, identifying a rare pattern in stock price movements, like the cup and handle or an Elliott wave, could suggest an impending significant change in market direction. Analysts use these insights to recommend timely investments, thereby gaining an advantageous position before market shifts become apparent to the wider investment community. Similarly, in environmental studies, the detection of rare patterns in climate data can signal the onset of significant changes in weather conditions, allowing for advanced preparation and potential mitigation of adverse effects. The strategic applications of rare and exotic patterns rely heavily on the ability to not only recognize these patterns, but also to understand their implications within a broader context. This understanding involves a blend of expertise, experience, and analytical skills to draw meaningful conclusions that can inform decision-making processes. Therefore, Incorporating the study and analysis of such patterns into strategic planning offers a powerful tool for forecasting and responding to emerging trends and opportunities across various domains. Exploring variations within the context of rare and exotic patterns involves delving into unique configurations and formations that are not commonly encountered in the standard analysis. These patterns can offer insights into potential market movements, but require a nuanced understanding due to their infrequency and complexity. For instance, a pattern known as the dragonfly doji, which appears in candlestick charts, signals a potential market reversal. It is identified by its long lower shadow and a lack of an upper shadow, resembling the tail of a dragonfly. This pattern suggests that the market opened and closed at the same price, indicating indecision among traders, but ultimately showing a rejection of lower prices. Another rare pattern is the cup and handle, which symbolizes a bullish continuation and is characterized by a period of downward movement followed by a stabilization and an upward trend, creating a cup shape. The handle forms with a slight downward drift before the price breaks out to continue an upward trend. Understanding the formation and implications of such patterns is crucial for identifying buying opportunities. Exploring variations and understanding these rare patterns require not only familiarity with their visual representation, but also an appreciation for the market conditions under which they emerge. Analysis involves considering volume, the pattern's position within a broader market trend, and corroborating indicators to validate potential forecasts. In essence, the exploration of rare and exotic patterns delves into specialized market phenomena, offering opportunities for those who can accurately interpret and act on the intricate signals they provide.